Good morning and welcome to Chapter 14. This is the first chapter in managerial accounting. And for some of you that don't know, we elected to put Chapter 14 in the managerial section because we felt that it's a challenge. And at the end of the semester, most of you are challenged to finish the semester on time. And so we wanted to cover this at the beginning of the next chapter. For those of you that remember, when you took Accounting 221, in the first chapter of the book, we talked about the three main financial statements: the income statement, the statement of retained earnings, and balance sheet. Well, the fourth one we also covered, but just briefly, is the statement of cash flows. Well, this particular chapter, we're going to cover in detail how to put together a statement of cash flows. Cash flows can be enlightening for a business to help them understand what's going on, particularly for external users to see if they're going to get paid back for what they owe. It provides a window into what happened within the business. And so we're going to talk specifically about the details about how to put together a statement of cash flows and what it means for your business. So the statement of cash flows, here we go. So what we're going to do, the first learning objective, we're going to talk about the purpose of the statement of cash flows and look at the three different categories of the statement of cash flows between operating, investing, and financing. Each one of them has a different character in how you deal with those, and we'll talk about the detail of those before we get into a review of what's in your text about how to do a statement of cash flows. The statement of cash flows talks about what happened, and it really talks about the receipts and payments of a business for a specific period of time. And so you're just trying to see what happened and where the business spent their money. If you put this in your own personal context, you would look at where did your money come in, which, your inflows would look a little different. In a business, it's a net income. But for you guys, cash inflows, or for you as students, it might be a paycheck. That might be the start of your personal statement of cash flows and some of the other stuff that goes along with it if you had your own personal financial statement. But it records what happened and how cash increased or decreased, and basically how the business spent money on their business, how they spent money, whether they tried to grow the business or what they tried to do with the cash that came in or went out. And it dissects it in such a way that external users can understand what happened with the business. And essentially it covers the same span of time as the other financial statements. And it's not a point in time like the balance sheet, but it's over a period of time. So the header on the statement of cash flows is going to say, for the month ended or the year ended, it'll have the same header as what you see on the income statement. And what are the purposes of cash flows? Well, you want to take a look at, first it explains what happened with the business, where cash went and how it went through the business. But more importantly, it helps businesses predict where their cash flows are going to be. And that's important because if you are short, particularly with operating cash flow, which has to do with paying your employees and buying inventory, for example. If you are short, you're going to have to figure out where you're going to have to borrow money in order to do well. It also gives a sense for the external users to look at the management of the business, and it predicts your ability to pay debts and dividends. So you have both bondholders or debt holders and stockholders are trying to figure out if the business is going to have enough cash to pay what is owed, or profits to pay a dividend, which is what's going to be a distribution of profits to shareholders within the business. In a statement of cash flows, there's three broad categories. There's the operating activity section, the investing activity section, and the financing activity section. The operating activity section is really going to focus in on the core operations of the business. If you're a merchandising company, it's buying and selling stuff. What do they do and how do they work with it? And it's going to focus in on the net income or net loss, as well as changes in current assets and current liabilities. And we'll talk a little bit more about the changes there in a minute. Investing activities, you're going to talk about how they invested in their business or divested. See, what do you mean by divested? Maybe they had a piece of land and they sold that piece of land. But when they sold that land, they got cash associated with that sale. That's going to be in the investing activities. Or if they bought a new building, that's going to be in investing activities because they're trying to invest in the business or invest in themselves. And then the last category is financing, and that's kind of how they paid for it. Some of it they might pay for the cash, a positive cash flow that they have out of operating activities. but they also might take out a loan or a bond or a long-term note to pay for their business operations. They might sell more stock. And finally, in the financing section, you also have dividends paid out to shareholders is going to be in the financing section. So that's just kind of a quick overview. We'll go into a little bit more detail about each one of these here momentarily. Operating activities is the first section on the statement of retained earnings, and it reports on the revenue and expenses. It starts with those, and in my opinion, it's the most important, because if a business does not have positive cash flow long term in the operating section, which is really driven by the net income or net loss of the business, if they don't have a positive cash flow in the operating section on a long term basis, they're not going to have a going concern. They're not going to be able to meet their current obligations. So that, to me, it's the most important, and they talk about it. Investing is the second one. We touched on this a little bit. And really what you're talking about here is long-term assets. Long-term assets like buildings or land or equipment. Those are the things that you're going to take a look at. And it looks at buying and selling of those long-term assets. So if you're looking at the balance sheet, on the asset side, the current assets are going to be in the operating activity section. The long-term assets are going to be in the investing activities section of the statement of cash flows. And finally, financing activity says, how did we pay for the stuff that we're going to do? How do we pay for our business? And you have long-term liabilities, which are going to be notes payable and bonds payable, among others. What you're not going to have here, though, are current liabilities. The current liabilities on the balance sheet are going to go into the operating section of the statement of cash flows. And finally, what do we look at in the financing section? We look at the issuance of stock, in other words, common stock or preferred stock, the paying of dividends, the distribution of profits, and if we have buying and selling of treasury stock. All those things are going to come out in the statement of cash flows for a business, in the financing section in particular. And here's kind of a summary of what we just talked about. And you notice the blue boxes are for operating cash flows, and the green boxes are investing cash flows, and the red boxes are financing cash flows. This is just a pictorial of just what we talked about. Now I want to touch on something here just for a minute that you won't see in your text, but I think it's important for you to understand this basic concept. Let's talk first about current assets. If you have current assets, and typically what you're going to do is you're going to look at the change in current assets, non-cash assets. Let's take, for example, merchandising inventory. If at the end of say 2015, you had $20,000 in merchandise inventory, and at the end of 2016, you had $30,000 worth of inventory, you've basically tied up another $10,000 in inventory. So that's going to be a negative. That's going to be a use or a tie-up of cash, of inventory on the statement of cash flows, because you have increased an asset which cost you money that you could have used somewhere else. So that's going to be a use of cash, and it's going to be a minus on your statement of cash flows. Now conversely, if we look, and obviously the reverse also holds true. If your current assets go down, if your merchandise inventory went from say 20,000 to 10,000, your merchandise inventory went down, and that implies that you turned that inventory into cash somehow, some way. So that's going to be a source of cash or inbound money. Conversely, if you look at current liabilities, if current liabilities increase, which means, let's say accounts payable went from 15 to 30,000, you had an increase in accounts payable of $15,000. Well, that $15,000 in effect is really a loan from your creditors and is a source of cash for your business. So when you do the statement of cash flows, that's going to be an add, but the reverse is also true. If your business sells, if your business has a reduction in accounts payable, which maybe is from say 25,000 to 10,000, that $15,000 reduction means that they paid off more loans or more bills to creditors in that particular year, so they're using up some of their free cash to do that. You can apply the same logic for long-term assets and long-term liabilities and equity as well. I'm not going to go through those in this particular discussion, but think of it this way. If you did a journal entry and the journal entry would debit cash, that's going to be a source of cash. Okay, so that means if you got a payment for accounts receivable, you're going to debit cash and you're going to credit accounts receivable. So that's a source of cash. If accounts receivable went down, you have a source of cash. And if accounts payable, if you think about how you pay accounts payable, you're going to debit accounts payable and you're going to credit cash. If you do that, in effect, it's a use of cash because you're tying up more money, or you're giving money to your creditors, and therefore you don't have as much cash coming in. So I know that's a long discussion, but just think about if cash comes in, basically, in other words, if something goes up, it's going to be on the liability side, it's going to be a source. And on the asset side, the current assets and also on the long-term assets, if cash would be debited, then it's going to be a source. Enough said on that. Let's move on. You also have what are called non-cash from investing and financing activity. Sometimes a business will just make a trade. They'll trade land, say, for stocks or bonds. Well, those non-cash transactions, they impact the financial statements of the business, but they're reported as notes. They're reported as notes to the statement of cash flows. Because what would happen, think about this for a minute. If you bought land and you issued stock to buy the land, okay? Well, first what you would do is you would show that the land is a use of cash. So you'd have in the investing section, you'd have a minus for money going out to purchase the land. But on the financing side, you would have money coming in based off of that bond transaction. So you'd have both, so they offset one another, but it creates a poor picture of what's happening with the business because you have tied both of those. Both categories are wrong. The financing section is wrong in the sense that it's too high as far as money coming in, and the investing section is too low for money going out. So two wrongs, if you do two wrongs, one each way, paints a poor picture for the external users of the financial statements. Therefore, they put those things, non-monetary transactions, in the notes to the financial statements. So here's a summary, and I would encourage you to look at this in your book. I'm not going to spend a lot of time here, and I don't think I really need to review this. This is something that we already talked about a little bit. The one thing that we'll touch on here in a few minutes is when we start doing the operating activities, what we're really trying to do, and what we're really trying to do in this whole statement of cash flows, is we're trying to take accrual-based accounting and take it back to cash basis. So we're making adjustments based off of what happened on the accrual basis for accounting. And that's really what all these transactions are set to do. And you can read through these and you can look at these, and when you're doing your statement of cash flows, I would suggest that you look at this exhibit 14.2 and then figure out for each one of the transactions what happened. Did cash go out or did cash come in? And from there you can determine whether or not it needs to be, if cash came in, it's going to be an add or an increase, and if cash went out, it's going to be a decrease. And I'll leave it at that. There's two ways that you can do a statement of cash flows. You can use the indirect method or the direct method. The predominant method is the indirect method. Like 95% of all companies use the indirect method for the statement of cash flows. So when you use the indirect method for statement of cash flows, that's what you're going to see in typical accounting. You're going to see the indirect method, and if you look at financial statements for businesses, that's what it's going to look like. And it'll be like that for all businesses for the most part. It's very rare that you're going to find the direct method, so we're going to focus predominantly on this indirect method, and we're starting with accrual income, and we're making adjustments to come up with cash, and we're using the relationships of the accounts to determine the changes in cash. So what do we need to do a statement of cash flows by the indirect method? We're going to need the income statement for the current year, and really we're picking up only two major things off of that. We're picking up the net income, and then we're picking up the depreciation expense and what happened with that. And we're also going to look at that to see if we had any gain or loss on the sale of assets, and we'll touch on that in a minute. We need the balance sheet for 2 years because we want to look at the net change on the balance sheet year over year, and we're going to use all of it with the exception of the retained earnings. which will be included in the net income and the dividend. So we'll talk about that in a little bit. And then we're also going to talk about some other transactions that will be provided for you. Okay? 5 steps. The first 3 are pretty obvious, right? You're going to look at the operating, investing, and financing sections, the 3 sections. We're going to look at the change in cash. And the last one, we're going to look at the schedule for non-cash activities on the bottom. So those are the 5 steps. And we're going to see, here's the first thing we're going to take a look at. Here's a comparative balance sheet year over year. So in effect, we have 2 years worth of balance sheets. And a couple things I want you to notice here. When we get done with our statement of cash flows, because what we're trying to do when we do our statement of cash flows is we're trying to calculate this particular number right here. So when we are done with our statement of cash flows, it's going to say net cash flows is going to be a minus $20,000. So what you're going to have as part of your statement of cash flows is you're going to see these 3 numbers. If you finish your statement of cash flows or you're to the bottom and the net number is not 20,000 to the bad minus, then that tells you that you missed something else, because what you're really doing when you do the bottom part, when you're reconciling the cash, is you're saying, okay, I had $42,000 at the end of 2015, and you're detailing, you're kind of doing a reconciliation of this 20,000, and it says that we had 20,000 that went out during the year in different forms, either operating, investing, or financing, and you end up with $22,000 at the end of the year. So that's a big thing you want to take a look at. The rest of these, we're looking at the comparisons of the changes. So let's use this accounts receivable as a simple example. Accounts receivable in 2015 had $73,000. In 2016, it had $90,000. So what that said is that the company tied up another $17,000 in inventory in 2016. In accounts receivable. So that's going to be a use of cash. They've tied up more money. Now the next one down, you notice it's a negative. That's going to be a source of cash. That just kind of gives you an idea of what's going on. Let's move on. So what we're going to look at here is there's a couple things we want to pick up. We want to pick up this $40,000 on the bottom. We're going to need that. That's going to be the first thing we're going to need for the operating section. And then the other major thing we want to take a look at here is any place where it says depreciation expense. Depreciation expense, like amortization and depletion, is a non-cash expense because the company did not write a check for that. Remember, that's taken a depreciation and amortization and depletion is really a systematic expensing of a long-lived asset. That's a non-cash expense. So you're going to add that back into the net income, and we'll talk about that in the operating section. So let's take a look here. Here's kind of the statement of, here's kind of the 40,000 foot view. And I'm going to start at the bottom and we'll work our way up just from here. So you notice the first thing we talked about, you had your cash balance as of 2015, $42,000. And here's your net cash, $20,000 that we talked about. And when you take the difference between these two, this number, if you went back to your balance sheet, should be the same, which we talked about. And you remember I talked about that it's $22,000. Now let's look back. We have each section: financing, investing, and operating. Let's go up to the operating just for a minute. There's the net income, and we're adding back that non-cash expense. And we're going to subtract out a gain because that is an accrual gain, not a cash gain. And we're going to come down here and we're going to look at this 10,000 and this 50,000 are going to be related, and we'll talk about that when we get to it, but I wanted you to see it here. And we had an increase in accounts receivable, so that's going to be a minus. So if you're working on this, you might say less increase in accounts receivable plus decrease in merchandise inventory, and you see these other two. These are all current. The ones from here down are all current assets. And then you have the change in plant assets and a cash payment. That's what you want to look at here. And then you have the receipt from when you sold this. So what you did is you lost, or you gained money when you sold this on an accrual basis, but you got $50,000 in cash. That's the more important number, and we'll look at that in a little bit more detail. And then here's the rest of the stuff in the investing and the financing section. They issued notes payable, they paid on a note, they bought some stock, or they sold some stock, and they bought some treasury stock, which means that cash went out because you would have debited treasury stock and credited cash. and they had a cash payment where you would have credited cash and debited dividends. So this just kind of gives you a 40,000 foot view of the statement of cash flows. So let's talk about the operating section first. And we touched on this earlier. We're looking at income on an accrual basis first, and then we're going to make adjustments. And we're going to look at those and deal with those as we go. And I'm not going to go through this example on the bottom because I think it's a little bit confusing, so you might just blow past that. But the first thing we talked about, and here's the one that we talked about, depreciation, depletion, and amortization are added back to net income. It doesn't say it here, but those are non-cash expenses. Cash does not go out. So if you had any of those, so if you wanted a broader definition here, you'd say add back non-cash expenses. So it won't just be depreciation. It might be several things, because now you're adjusting this to a cash basis. So if this was cash basis, your cash basis income just from that alone would be 60,000, not 40. Okay? And then we have gains or losses on the sale. And we saw from the income statement that we actually had a gain, but we want to back this up because this is a non-cash gain. It's an accrual gain. And we want to back this away. And if we had a loss here, we would add it back to it. Okay? So we're making an adjustment. So this number is overstated by the 10,000. The accrual-based net income for the gain on disposal of assets. And then you go a step further and you say, okay, here's all the changes in my current assets and current liabilities. I'm not going to go through this, but you notice what you have total. It's this plus or minus the change of this. So we must add a $10,000 decrease total. So we still had a positive cash flow at Chatper of $30,000 from operations. Now, I take that back. This was sum total was 30. I'm sorry. And then so you have $70,000 was the positive cash flow total. Okay? Cash flow from operations. And here's just a little summary of what we just talked about. This would be one of the things you might want to take a look at in your notes. But you can also look at this as source and use. Wherever you see a plus, that would be a source. And wherever you see a minus, that would be a use. Source and use. I like that term better than the pluses and minuses, because you can learn that. So this would be a source of cash. And these ones down here, particularly these last four. That's going to be a use, a source, and a use. Okay? Then we look at investing. We're looking at plant assets and investments in other companies and notes receivable. And so the first thing we're going to look at deals with plant assets. And this is what the journal entry would look like if you had plant assets. If you sold something, what you're going to do is you're going to take that plant asset, which was an asset on the book that was debited before, you're going to credit it. And you have accumulated depreciation that you need to debit because you want to clear that out. And it doesn't tell you this, but you can calculate this based off of this, and it says that they got the difference. So you have 65,000 here, and you have 15,000 here. So this has to be 50,000. So they got $50,000 for something that that had a net book value of 40. So they made 10. And so when they do that, we're going to take that 50,000 and add it back in. And if we go back to the balance, that's this 50,000 here for the cash that they got when they sold that plant asset, not the 10 that they made on an accrual basis. The 50,000 represents the cash that they got. So you have also the net change in plant assets was it's not the net change, it's what they bought in plant assets was $310,000. So they actually had a net negative cash flow from investing activities of $260,000. And you would have to interpret that as a good thing, that they're spending money to grow their business. Now, if you had a business where this was a positive cash flow, always a positive, you might be concerned. Because what that's telling you is that they are selling off portions of the business that they could be used as productive assets. And so they might do that in the short term because the business is struggling on the operating side. But in the long term, that is not sustainable. You can only sell so many assets before you run out. And once you run out, you better figure out how to make your business, your operating business good. If it's not good, if you're not having positive cash flow from operating activities, the long-term viability from your creditors and from your suppliers and also from the companies that you sell to may be in question. Cash flow from financing activities. You have long-term notes payable, bonds payable, common stock, and retained earnings. And there's one more here that they don't have listed, and that's treasury stock. Treasury stock obviously is a contra equity account, and it's when you buy back stock from your business, or you might turn around and resell it. Treasury stock, that's also going to be one in financing activities. And what we're going to look at here is you can calculate what the dividends amount is if they don't give it to you. Here's a formula. And it says that they paid out $10,000 in dividends. So you can look at this formula, and this will tell you what they paid out in dividends. But for this particular case, we know it was $10,000. But you can use this formula because you have all these numbers. The only one you don't have, and even though they don't have this really written this way, is this one over here, right? And they didn't have a net loss, and this is a net loss or a net gain. So depending upon which one. And this tells you what your ending retained earnings is. So for this, we have the balance, we have the net, we have the income statement, we have the balance sheet with the ending retained earnings, we have the balance sheet with the beginning retained earnings, and we look at the difference. So that's what you're going to take a look at. So here is the financing section for the statement of cash flows. They got money when they issued notes. Then it looks like they also paid off a portion of probably an old note. And then they have receipt from common stock, which means that they sold common stock, but they also bought back some treasury stock for $20,000. And here's the dividend payment that went out. Remember, always think about what would I do? What would I debit? What would I credit? If you're going to debit cash when cash comes in, that means it's going to be a cash source of cash. If you're going to credit cash, it's going to be a use of cash. So you can kind of look at these and get a sense about what happens. So they had, looks like they spent 107. They got in 170,000 between selling these stock and paying off this note and paying their dividends. So really, if you go back and look, they probably took this 170,000 plus some of the positive cash flow they had from operating to pay to buy their new equipment, the new building that they're going to do for their business. Okay. And the last part, we're taking the sum of all these. And your statement of cash flows, this is just kind of the summary, but actually you would have each one of these divided. And it says that you had a negative cash flow of 20,000 or a decrease in cash, and your beginning was 42,000, and you have a cash balance of 22. So you can see what really happened with all these. And remember, these two numbers, you should, all three of these numbers you should see on your balance sheet. That's the change in cash. The other number, sorry, I went to the next slide. The other number is going to be the beginning balance for the year, or the ending for the prior year, and the next one's going to be the ending. And here is the non-cash investing in financing activities. They issued common stock to get that building. They bought land they got land with the issuance of notes, and they retired notes with by issuing common stock. All non-cash transactions. These are on the bottom here. Okay? And there's $470,000 of investing in financing activities that were non-cash. And you don't want to put those in like we talked about, because it's an in and an out, and you don't want to do that because it distorts the rest of the statement of cash flows. Free cash flow to evaluate business performance is the last learning objective. We want to know how much cash a company can free up for new opportunities. So we want to look at free cash flow. And it's really looking at cash available from operating activities after paying for planned investments in long-term assets and dividends. So you're going to take whatever they have and say, okay, what money do they have to pay me? That's what's, it's all about me, is it, how does that goes? So we're going to look at that, and in this particular case, it says ShopMart expects net cash provided from operations of $200,000. It plans to spend $160,000 to modernize its facilities and pay $15,000 in cash dividends. So the free cash flow is going to be basically the $200,000 less the $160,000 less the $15,000. So they have free cash flow of $25,000. That's the end of chapter 14. I hope you enjoy my class, and I look forward to having you this semester. If you have any questions or concerns, feel free to email me, or if you're on campus, you can stop by. I'm in BA 225. Thanks.